Good day, ladies and gentlemen, and welcome to the show on this Friday, November 4th, 2022. Thank you for tuning in. Glad to have you guys here. I was looking at an article today. It was talking about retirement savings for your retirement. Last year they were talking about you need $1 million to retire on. This year they're saying, okay, you need 1,200,000 to retire on. Right? And it said, would that be enough? So it's a 20% increase in what you need. And that's just about exactly correct, because the real rate of inflation over the CPI numbers is about double, or maybe a little bit more. So everything over the last year is raised in price by about 20%. Means what you can purchase with your money has lost 20% of its value. But let's think about this a little bit further. Now, it sounds like an awful lot of money to retire on. $1.2 million you need to retire, and most people out there haven't got that. But let's see, would that really be enough to retire on? So in the last year, it basically means, so say you get that money set, $1.2 million. Well, you're going to lose 20. That means you're going to lose 200,000 of the purchasing power of that money over the next year. But then how much are you going to need to actually live on above that? So just after your first year, what you can purchase with that money, it's lost in inflationary value, it's lost, is over $200,000. So that means just after the first year of retirement, if you've got $1.2 million, it means you're probably going to have like $900,000 left. And the next year, you're only going to have like $600,000 left, or even less than that. Doesn't sound so good now, does it? Your money's been cut in half in just the first 2 years, mainly because of inflation and cost of living. What's going to cost you to live. So after about 4 years, you got nothing left. So if you're planning at 1.2 million, if you're only planning to plan on retiring, and you're only going to plan on living off your money for about 4 years, so you better plan on dying after that 4 years is over. So that means if you retire at 65, you ain't going to make it to 70. And the people out there who are working on annuities and things like that, and fixed incomes and things like that, they're getting cut to pieces right now. Let's get in there and let's take a look at some of the stuff that's going on out there right now. And let's open up the charts. Let me get the charts going. Give me a second, guys. Let's open up the charts right here. First off, one of the things that I've been hearing through the grapevine is that the last rate hike is going to be coming. The last rate hike is going to be coming in December. That's what I've heard through the grapevine from the Fed. Now I haven't got a surety on that yet, but that's what I've been hearing through the grapevine, that the last rate hike is going to come in December. And the reason why, if that's true, it hasn't been verified yet, but if that becomes true, if that does happen that way, the reason why is because the political pressure is starting to come in on them, on the Fed, because of the effect it's going to have on the economy and common everyday people out there. That they're going to be doing a pivot, but probably before the end of this year. And that has to all be verified now. So don't accept that as gospel truth. One of the things we're seeing happening today is the silver price is popping up. It was up nearly $1. At its peak right here, it touched almost 20.50. That's good for silver for a 1 day. That's a good raise in the price of silver. Let's take a look at gold right now. Gold is at 1664. It's up $34.10. You see quite a big bounce for gold too today. Nice to see the numbers moving up. One of the things is I'm very suspicious that the Fed's doing something behind the scenes to support these markets. And something moved the MOVE index down a substantial amount overnight, meaning some stability entered in. Why would you get stability when you've got this kind of an effect going on of quantitative tightening and raising interest rates? When that support on the opposite side of that, which is quantitative easing and lowering interest rates, was what supported these markets and put a leg underneath them or a floor underneath them. And now that they're removing that, why would you have stability coming in? It doesn't make sense unless they're doing something that can't be seen. That's what I'm suspicious of, but ultimately in the end, when they change direction on this, and which eventually they're going to have to, because they can't go too high with interest rates. They have an outstanding debt. The national debt is like over $30 trillion, and they have to make payments on that debt. They have to, and interest rates get too high, it's going to increase the amount of the, basically it's like if your rate goes up on your credit cards, and you have to pay more for your credit cards. Say your interest rate goes up on the credit cards. You can only afford so much, and that's the way with the debt. They can't service it if it gets too high. Interest rates get too high. They cannot go up to what it took to quell the inflation of the 70s during the Paul Volcker era. They can't afford that now. So it's just like everything. I think that this period that we've been through, where we've got the Fed raising interest rates, is starting to come toward a close pretty soon. And we're entering in the first stage of inflation. We're getting toward the end of the first stage of inflation and getting ready to kick into the second stage, where inflation's going to increase profoundly high, ultimately. But we've been on this path for over 100 years. Do you realize what a dollar would buy back around 1912? Do you realize that you could go out into the Midwest of the United States and you could buy a whole farm with farm animals, farm equipment, a house, a barn, 40 acres for like $50 or something? And I mean, now look at what our dollar's become compared to back then. Now $40, or I should say 100 times, well, not 100 times that, but many multiples of $40 was required just to get the lawyer off of his chair to, I was gonna say fat, you know what, to move across the room to do part of the changing hands of the deed and title changes and stuff on a house. Or just to get a guy in to take a look at the house to do an inspection for the bank or whatever. Costs more than back then. You could buy the whole ranch. And he just walks through the house for 10 minutes going around like this, and that's it. That costs more now than it cost for the whole ranch back then. Anyway, I'm getting sidetracked a little bit here, but we're looking at a gold price that's up substantially. Well, $31. See, this is what I'm talking about. Right here, guys. Gold is up $31 today so far. That's what gold was for an ounce. It's moved up the price it used to be for a whole ounce. Used to be you could buy an ounce of gold for that. In fact, back then, when they the last time they confiscated the gold from the people, they did. I think they only paid them $25, didn't they? An ounce. Now it went up $31 just this morning. I mean, this shows you how your money's being eroded in value. Cryptocurrency today, we're looking at 1038, so it's went up $38 billion overnight. 20,718, 16 for Bitcoin, and Ethereum's at 1608. Take a look at the stock market today. The Dow Jones, which is a primary market that I follow on this channel because it's the biggest. 32,212. It's up 195 points. I probably should follow the Standard and Poor's, S&P 500, too, because it's another big market, you know. But anyway, here we go. It's up 32,212. Let's take a look now at crude oil. $92.20. It's up $4. Now that's just that when it makes that big of a leap in price, you see it at the pump. So you're going to see this at the pump. Probably 10 cents or something, 20 cents, depending on where you live. You know. A move index today, 136. Now this was a big drop overnight in the move index. But it's still not out of this trend that it's been in. You see? If you're into charting analysis, you'd see there's an upward trend here, and it hasn't broken through the trend lines. So it's a 136.28, but it is getting down near the bottom of the trend line right now. Let's take a look at bonds and rates today, and we're seeing climbing yields again. 3 basis points on the 10-year at 4.15. And the 30-year is 4.22. It's up 7 basis points. Excuse me. And now for the U.S. dollar index. At 111.82 on the day. It's down a little bit. Thank you guys for listening to my show. Like and subscribe. And don't forget to hit that little notification icon. And we'll catch you guys in the next episode. You guys have a great day. Bye-bye.